the top 15 lessons from the intelligent investor. Number 1. Investing versus speculation. Understand the difference between investing and speculation. Investing involves thorough analysis and aims for safety of principal and adequate returns. Speculation is based on market fluctuations. Investing is like planting a tree. You research the best type, find the right spot, and nurture it over time. Speculation is like gambling which way the wind will blow tomorrow. Knowing the difference helps you make smarter financial decisions. For example, investing in a company's stock after studying its financial health is smarter than buying because of a sudden price jump. Speculators often chase trends, while investors stick to fundamentals. Understanding the distinction can save you from costly mistakes. Number 2, the margin of safety. Always include a margin of safety in your investments. This principle protects investors from significant losses due to unforeseen market changes. Think of the margin of safety as a cushion. If you buy a stock worth $100 for $70, that $30 difference is your safety net against market drops. This way, even if the stock underperforms slightly, you're less likely to face a major loss. A margin of safety acts like an insurance policy. It may not guarantee returns, but minimizes potential losses. Number 3, Mr. Market's mood swings. Don't let Mr. Market's mood swings dictate your investment decisions. The market's volatility should not influence your perspective of an investment's value. Imagine a neighbor who offers to buy your car every day at a different price. Some days he's too high, other days he's too low. You wouldn't sell just because he's moody. You'd wait for a fair offer. Treat the stock market the same way. By focusing on the intrinsic value of an investment, you can ignore the noise of short-term price fluctuations. Number 4, the defensive investor. Adopt a defensive investment strategy to preserve capital. Focus on minimizing risk and avoiding significant losses rather than chasing high returns. A defensive investor is like a cautious driver, always alert, avoiding risky shortcuts and prioritizing safety over speed. This approach helps protect your investments from major downturns. Defensive investors focus on steady, reliable returns rather than volatile opportunities. Number 5, the enterprising investor. Be proactive and diligent in seeking undervalued investments. It requires more time, effort, and market knowledge to identify and capitalize on opportunities. An enterprising investor is like a treasure hunter, researching, digging deep, and uncovering hidden gems in the market. This strategy demands effort, but can lead to substantial rewards. For instance, spotting a small company with great potential before it becomes popular can yield massive returns. Number 6, focus on intrinsic value. Invest based on company's intrinsic value, not market price. Intrinsic value reflects a company's true worth, independent of its current stock price. Think of a company's intrinsic value as its real underlying worth, like the value of a house, based on its structure and location, not just the current market hype. Investing with this in mind leads to more informed decisions. Overpaying for stock based on hype can be risky if its intrinsic value doesn't justify the price. Number 7, diversification. Spread your investments to minimize risk. Diversification reduces the impact of a poor performing investment on your overall portfolio. Diversification is like not putting all your eggs in one basket. If one basket drops, you still have the others. By spreading your investments, you protect yourself from major losses. A mix of stocks, bonds, and real estate can balance risk and rewards. Number 8, avoid market timing. Don't try to predict market highs and lows. Trying to time the market often leads to missed opportunities and losses. Market timing is like trying to guess when the traffic light will turn green. Instead of waiting and guessing, focus on steady, long-term progress. Even seasoned investors often fail at timing the market correctly. So consistency is your best strategy. Number 9, control emotions. Emotions like fear and greed can cloud judgment. Staying disciplined and logical is key to making sound investment decisions. Investing with emotions is like driving while distracted. It increases the risk of mistakes. Stay calm and stick to your plan, even when the market feels chaotic. For example, panic selling during a market drop can lock in losses that would have recovered over time. Number 10, the power of patience. Long-term investing yields better results. Patience allows investments to grow and compound over time. Patience in investing is like letting wine age. It gets better over time. By staying consistent and allowing your investments to grow, you'll see significant rewards in the long run. Compound interest works best when you give it enough time to accumulate. Number 11, understand the business you invest in. Invest in industries or companies you understand. Knowing the business helps you assess risks and opportunities better. When you understand the company, you're more likely to make informed investment decisions. For example, if you know tech, you'll recognize trends or challenges that may impact tech stock. Avoid jumping into unfamiliar industries just because they're trending. Instead, research and build knowledge. Number 12, reinvest dividends. Reinvesting dividends accelerates wealth building. Compounding works faster when you reinvest your earnings. Reinvesting dividends is like planting seeds from your first harvest for a bigger crop next season. Over time, this strategy significantly amplifies your returns. It's a simple and effective way to grow your wealth without additional effort. Imagine reinvesting $100 dividends annually and watching it multiply over decades. Number 13, focus on costs. High investment fees eat into your returns. Low-cost investments help preserve more of your profit. Imagine your investment profits are reduced by high fees. Choosing index funds or ETFs with low fees ensures more money stays in your pocket. Over time, lower fees compound into larger savings. Review investment options carefully to minimize unnecessary costs. Number 14, regularly review your portfolio. Keep your investments aligned with your goals. Rebalancing ensures your portfolio matches your financial plan. Regular portfolio reviews help identify underperforming assets and overexposed areas. This ensures that your investments align with your risk tolerance and goals. Think of it like a health checkup. For your finances is essential to keep your portfolio in shape. A balanced portfolio performs better over the long term. And number 15, know when to sell. Have an exit strategy for your investments. Selling at the right time can be just as important as buying. Knowing when to sell prevents losses and secures gains. For example, if a stock hits your target price, it may be time to cash in and reinvest elsewhere. It's not just about profit, but also avoiding holding on to a declining asset. Successful investors plan their exits as carefully as their entries. Thanks for watching Nova Society. Please subscribe to the channel, like this video, leave me a comment with your thoughts. If you're interested in reading this book for yourself, The Intelligent Investor, I'll go ahead and drop a link in the description for you. Until next time, peace.